How to invest your $1,000 in 2022 step-by-step tutorial. Welcome back to Wealth-ology. For today's video, we'll be going to talk about how to invest $1,000 in 2022. Let's get started. Who has ever been the fastest self-made millionaire? While Warren Buffett took 55 years to become a millionaire, Jay Walker just took a year. During the dot-com bubble, he established Priceline.com, and his net worth went from zero to billions in an instant. However, when the bubble burst, his net worth plummeted as well, whereas Buffett remains at the top of the list and shows no signs of slowing down. That's the kind of fortune you want to accumulate. Money isn't a simple game. It's structured, competitive, and merciless, and you're condemned to fail if you don't grasp the rules. The problem with most people is that they might work hard their entire lives, but end up poor at the end of the journey because they don't know how to let their money make even more money. In other words, they don't know how to invest. Let's assume that you have been saving money and have an extra $1,000 in your bank account. That's already an achievement because nearly 70% of Americans don't even have an extra $1,000. So instead of spending it on another useless gadget or a pair of shoes that you will wear once and then keep in your wardrobe for many years before you finally throw it away, let's assume you're going to invest that money. But how do you put your first $1,000 to work for you? Do you put in the stock market or in real estate? What types of stocks do you invest in? Is $1,000 sufficient to begin investing? Consider these examples to better understand what investing is and how it works. Let's imagine you work really hard and save $300,000. You could go to a Ferrari dealership and buy a luxurious automobile to show off your achievement. Or you could buy real estate and rent it out. Every month you will receive at least $2,000. If you decide you no longer want to keep receiving that $2,000 paycheck every month, you can sell it and get back your initial investment. In fact, the value of your investment might even appreciate, so you will sell it for a higher price. And that's how money makes money. However, $1,000 will not buy your real estate. That is insufficient for a down payment. That isn't to say you can't put those $1,000 to work elsewhere and see them develop. The simplest solution is to put it in your savings account and earn interest. But why would the bank pay you to keep your money in the bank? Shouldn't they instead charge you? No. The bank will take your money and lend it to someone else at a higher rate, with a portion of the profit going to you. That's how bank works in the short. The only problem with this strategy is that interest on the deposit account is so low that it isn't worth it. The highest rate you can get is 0.8%. This means that if you invest that $1,000 into a savings account, 12 months from now, you will receive an extra $8. That is extremely low because the Fed targets an inflation rate of 2 to 3%, which means if you are not getting at least 2 or 3% over time, the real value of your $1,000 will depreciate, which means you can buy it with fewer goods every year. But why are interest rates so low on deposit accounts? Because interest rates in general are low this year since the pandemic forced the Feds to lower them to encourage everyone to borrow money and spend. A year or two from now, once we get out of this recession, the Fed will increase interest rates to 1, 2, or even 3%, which means interest rates on the savings account will rise as well. Your second option is to buy government bonds. A government bond is a government issue asset that is used to raise funds for government spending. If the government wants to build a school but doesn't have the funds, it can issue an IOU, a piece of paper that states that the United Government owes the owner of the security this much money plus interest. Of course, this is an oversimplified example, but this is the point in short. Government bonds are heavily influenced by interest rates, so since interest rates are extremely low this year, government bonds rates are less than 1%. But 2 years ago, when interest rates were high, government bond rates were as high as 3%, which is not bad, since government bonds are the safest investments you can ever make. Any investment carries with it a certain level of risk. If you are loaning money to the US government, what are the chances that the US government will default on its loans? For the US government to go bankrupt, the entire US economy might have to fail. That's why US bonds are considered to be the safest investments in the world. But if you want to make a higher return, let's say 10, 20, or 30%, then you have to consider investing in the stock market. For example, Amazon's stock price increased by over 80% just this year. Google's stock price rose by almost 30%. Tesla's stock increased by 721%. Then the question is, why would anyone invest elsewhere when you can double or even triple your money in the stock market? The answer is risk. For example, when it comes to government bonds, there isn't much risk. In fact, it is a risk-free to a certain extent. But when it comes to individual companies, there is a risk that a company might fail. It might report negative earnings, and pretty much any negative news can drive the stock price down. The company might release a product, and if the public doesn't like it, that can make some negative headlines, which can drive the price down. So with higher returns comes more high risk. Apple is a well-established company and its chances to fail are way lower than Tesla, but also has less room to grow than Tesla. That's why Tesla grew by 721% this year, but Apple by just 17%. What you have determined for yourself is how much risk you can take without going nuts. If that $1,000 is all that you have left, maybe risking it all isn't the wisest option because if things turn south, you can end up losing most of it. So one way investors minimize their risk in the stock market is by investing in an index. The most famous one is the SP 500, which tracks the top 500 US companies. So an index fund would basically invest in these top 500 companies. Some of these companies will definitely fail, but others will grow. Judging by the historical data, the average return rate for the SP 500 since the 1920s was around 10%. This means that buying a share of these index funds means you are buying a tiny share in the top 500 US companies. My 3 top favorite index funds are View, or Vanguard 500 Index Funds, QQQ, and index funds by Invesco and Fidelity Zero Total Market Index Fund. All of them are great and invest in pretty much the exact same company. But how do you buy shares in these index funds? I mean, where do you start? First, you need to find a broker. Someone is qualified to sell you stocks. In the past, it was always someone. You had to pick up your phone and call him and ask him to sell you some shares. Remember the Wolf of Wall Street? He would spend his entire day calling people and trying to sell them worthless stocks. But thank God we are in 2020 and things are much better and easier. Brokerage firms created apps so that you can buy shares from the comfort of your smartphone, such as Robinhood, Webull, and so on. All you have to do is download one of these apps and sign up, and you can start investing right away. In fact, if you use the link below to open a Webull account, you will get 2 free stocks. Just a disclaimer, it's an affiliate link. So, which of the investing techniques have you found to be really useful? Please let me know in the comments section below. And if you like this video, please give it a thumbs up, turn on the notification bell, and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video. Bye!